Hi friends, this is C. Ashwini Astogi. So digital economy is taxed in India under the Income Tax Act. So the various concept business income is there. Suppose your income accrue arise in India, you are liable to tax in India. P permanent establishment concept is there. Significant economic presence concept is there in the business connection, and equalized levy, which is completely outside the income tax provision. So what will be the future? Future is BEPS, base erosion profit shifting. OECD, Organization Economic for Cooperation and Development, is doing project BEPS. For BEPS 1.0 is already in phase 15 action plan is implemented through the Finance Act. Now BEPS 2.0 pillar 1 pillar 2 approach is working on. They have released global rules, commentary, and example. Pillar 1 is related to market nexus. If you are business market in India, they want to tax your profit in India. Same way, global anti-base erosion through global minimum tax levy. The global rules, which Premal says, provide for coordinated system of taxation intend to ensure large MNE pay minimum level of tax on the income arising each jurisdiction where they operate, if so does by imposing minimum top-up tax. So top-up tax concept is there. It's a coordinated on jurisdictional basis. They want levy minimum tax. So what the pillar 2, pillar 1? Pillar 1 basically they want to focus on the corporate where global turnover is 20 billion euro, and pillar 2 is where turnover is 750 million. So under the pillar 2, 4 global rule. We are already on focus on pillar 2. Basically pillar 2 is mainly applicable for a MNE having a turnover exceeding 750 million euro. That is as per the consolidated financial statement that say around 6,400 crore rupee turnover. OECD want to levy 15% tax. There are four concepts subject to tax rule, income inclusion rule, under tax payment rule, switchover rule. So IRR, UTPR to be included in the domestic tax, STTR, SOR to be included under the tax treaty. So the MLI 1, 2 in phase manner amendment in treaty. Global rule, it is a global rule, global anti-base erosion rule. We short say global rule. Do not compel any country to adapt minimum rule tax. If source country does not levy minimum tax, then other jurisdiction would levy tax. So what is the pillar 2? It's apply market nexus rule to allocate income in respect of particular market jurisdiction. The concerned MNE should have derived at least 1 billion euro in revenue from that jurisdiction. Suppose you have a subsidiary around the world, a particular jurisdiction, your subsidiary profit is less than 1 million, then that subsidiary outside from the pillar 2. So same thing, if that particular jurisdiction GDP lower than 40 billion euro, then this nexus will be set up at euro 250,000. So country are free to apply IRR to MNE headquarter. Pillar 2 would stand support with four interconnected rule. IRR, it's simple, same CFS rule, impose additional tax, top-up tax on the parent entity if the constituent entity is in the low tax jurisdiction. Under tax payment rule is a fallback rule to be applied only when the parent entity jurisdiction does not apply IRR. It deny deduction, make adjustment to undertax companies under the group. STTR, incremental tax withholding applied if the recipient is taxed at the lower tax trigger in respect of only specified passive income related party transaction. Suppose you are a subsidiary in Mauritius, Mauritius earning interest income, and Mauritius not tax at their jurisdiction, then we will apply STTR through the treaty. So SOR, it's a resolve conflict between domestic tax and tax treaty. So this is the major concept. Mark my word, everything will be changed after coming Pillar 2 by the OECD. So IRR and UTPR are interlocking rules would be included in the domestic tax. Where STTR, SOR would be included in the DTA. Pillar 2 take into consideration of CPCR mechanism as well. So what is going on? They want ETR. Every country jurisdiction should have ETR 15%. If your jurisdiction is ETR below 15%, then top up tax will be applicable. So what is going on? Government of India has released a press note on 24th November 21 and agreed with USA to phase out 2% equalization levy being digital unilateral tax measure. This says if pillar 1 is implemented, then we will phase out 2% equalization levy. What is going on in past? They release blueprint. This is the called blueprint book released by the OECD. So this OECD book is available on the OECD website. You can download, read the rules, what the rule says, and what the commentary says, and given the example. In July 21 conceptual agreement of G20 OECD inclusive framework on BEPS with respect to BEPS 2.0 project. As I said, November 21 government is agreed. You release pillar 1, pillar 2. India position is wait and watch. If every country is adopted, then might be India definitely will adopt it. So in October 21, 137 member jurisdictional member reached broadly consensus on this parameter of PEPS 2 project. December 21 release of model rules. Now we are expecting commentary on model rules, implementation framework, model rule for STTR. By the year end, we are expected pillar 2 to be brought into tax law. I'm not expecting in this coming budget March next finance bill Indian government will implement uh, this pillar 2 approach in the finance act, but next year definitely they will come out with this amendment of pillar 2. So IRR to be brought by the next year and UTPR will be in 2024. So what is the multinational group? So multinational group, suppose you have a subsidiary and your group entity in India only, then this global rule is not applicable. It is applicable only where if you are operating around the world. You have India and your subsidiary in Mauritius and your some permanent establishment in UAE and subsidiary also in Bermuda or some tax haven country, then it will be called M&A group. So there must be concept of one more jurisdiction you must have presence. So 750 million euro in respect of revenue, it says if your group revenue in a relevant period 2 out of 4 preceding 4 year from the tested period, then you will considered in the considered in the scope. So in this example, our revenue in 2 out of 4 is more than 750. We are in the scope. Otherwise, we are not in the scope. So STTR, TT measure, MLI based taxing right to the source jurisdiction. Globi rule, it's a domestic law base. First of all, domestic minimum tax, taxing right to the low tax jurisdiction, IRR, taxing right to the ultimate parent entity jurisdiction. UTPR, taxing right to the jurisdiction with the substance. So what the method, how you calculate? It's a simplified thing. Step 1, aggregate your global income, global taxes. So now compute your effective tax rate. Tax nominator and denominator is global income. If your effective tax rate more than 15%, no need to further excise. Everything is okay. No globally rule is applicable. But in case your effective tax rate is fall below the 15%, then shortfall, it's called top up tax. Top up tax is applicable. So formula is 15% minus jurisdictional ETR. So excess profit need to be computed. This is top up tax shortfall 15% is applicable only on excess profit. If you are not getting some amount of profit from that jurisdiction, no, we will not apply Globi rule. So normal Globi income minus substance based income exclusion is there. So SBI substance based income formula is there. 10% of payroll cost plus 8% of asset. Then need the if over and above you arrive this profit, then we will apply top up tax. So jurisdictional top up tax will apply on the excess profit only. And step 7 is recoverable amount, jurisdictional top up tax minus domestic minimum top up tax. So let's be see in the example, it's clarified everything to you. So now I take a good example for jurisdictional blending. We have to see on jurisdictional basis. You have a ultimate parent entity in India. You are earning 1,000. Tax rate is suppose 30%. You have three subsidiary A, B, C, D in UAE or some other country, and your income is 2,000. Second subsidiary from the UAE entity is 5,000 loss. Then you need to add back, you need to compute all jurisdictional blending. And here in UAE you do not pay anything, and in India you are paying 30%, so your ETR is 0%. So top up tax is 15% is applicable. We have to see jurisdictional blending. But in case your global you have a subsidiary in Brazil, Malaysia, and another subsidiary in some case Dubai. Then in Dubai there is no tax. Now Dubai has implemented 9% tax rate, but that is something else. That is not a domestic minimum tax that is defined under the this Globi rule. It says Globi rules that define domestic minimum tax rate. Dubai does not pay anything on 4,000 profit. Brazil does not tax anything because you are earning losses from the Brazil. And 2,000 from Malaysia, your liable ETR is 20%. So top up tax is applicable in respect of Dubai, state C. So what is says that if state C, Dubai guys, wake up, apply domestic tax rule. If you apply domestic tax rule, then it's okay. We will not go to parent entity, ultimate parent entity. If Dubai does not apply domestic tax rule, then we will apply IRR to the parent entity. If parent entity also not adopt Globi rule, then we will go to country A, country B for UTPR. So this is the major concept. We see this example as well. As per the present regime, Dubai is nothing is slight tax, and pre-Globi rule 35% is our ETR. So post Globi 600, that is 15% on 400 from low tax jurisdiction need to be taxed as the Globi. So this is after Globi, our effective tax rate is 65%. So as you see, first of all, DMT is applicable in the state C. If state C doesn't recover DMT, then IRR will be applicable in the ultimate parent entity. After that, UTPR is there. So we will see how it's work in the this slide only. So remain with us and watch the complete video till end. So now where the pillar 2 is not relevant. If you are earning normal profit, then pillar 2 is not applicable. It says demonize exclusion. If your global revenue for particular jurisdiction is below 10 million euro, that is around 85 crore, and global profit is less than 1 million euro, then global rules is not applicable. Sector carve out is there. If you are running some kind of shapes, then tonnage tax system is there, then global rule is not applicable. As it also says portfolio, if you are invested in some kind of subsidiary and earning some passive income or dividend, uh, capital gain, then global rule exclude that profit. It says if you are holding less than 10%, then portfolio profit for dividend and capital gain is subject to. So if your in portfolio investment is less than 10%, then Globi is subject. So it says if some entity in overseas low tax jurisdiction is considered POEM resident in India, it regarded as located in India for Globi rule purpose and will cease to be low tax considered entity. So this is the top down approach. It says in respect of we will levy Globi in respect of a country which has situated in low tax jurisdiction and no not uh, pay tax less than 15%. First of all, ultimate parent entity will apply IRR. Then if A state will apply IRR, then B and C will get exemption. In case of B apply IRR, then C get exemption. So this is the scenario top to bottom is followed. Now we see in case of split ownership, 75% is owned by the ultimate parent entity and 26 by some other third party. Then in that case, it is suggested that lower the tier will apply the IRR, so that suppose top up tax in this particular D company jurisdiction which is situated in low tax jurisdiction having top up tax 10,000, then 100% need to be allocated from the B country. If suppose it allocated from the A country, then 74% of 10,000, only 7,400 will be recovered. So it is suggested in the rule itself, commentary itself, to apply from the lower side. Normally it is followed from the top to bottom, but in case of split ownership, lower country is suggested. So this is the example. We will explain how it's work and how it's tax. So suppose it's an example of IRR and TUT, tax on top of tax calculation. So first says profit top up tax is splitted between income ratio. So ultimate parent entity has two subsidiary in low tax jurisdiction. One which they have 80% stake and another one is 51% stake. First one, A1 is 1000 revenue, second is 4000 revenue, and in A2 nil, no tax rate. So it suggested that as in our previous example, our total revenue is 1 plus 4, 5000. and our tax is 1000 multiplied by 25%, it's 25 or 250. So our ETR is 5%. So top up tax is 10% difference. So 10% is top up tax which is applicable on excess profit only. So now we compute excess profit. Our total profit is 5,000 and excess profit is 2,000. We reduce substance based income exclusion. So excess profit is 3,000. So 10% of excess profit is 300. That is subject to IRR. So this is the main concept. We need to work out what is the uh, excess profit and how TUT will be applicable. So how it will be collected. So 300 further split over the ratio of revenue. So 60 or 240 is the proportionate allocation of jurisdictional TUT. So 80% of ultimate parent entity is hold. It's pertain to A1 company and 120 is pertain to A2 companies. So total recoverable TUT is 170. So this is the scenario in this case. So now we come to example of under tax payment rule UTPR. Suppose C not implemented adopted DMT. In our example, Dubai is not adopted DMT. P India parent entity also not adopted global rule. So ultimate the substance based tax will under the Brazil or Malaysia in our example, because DMT is not taxed in Dubai. Ultimate parent entity has not adopted global rule. So how it work? So C company is having TUT is 600. In same thing, 4,000 profit, 15% TUT is 600 is TUT. So P not adopted Globi, C not adopted DMT, AB has adopted Globi rule. Those are situated in high tax jurisdiction. So first of all, we will split on the basis of payroll cost and the tangible asset. So 50% of payroll cost and 50% of tangible asset in proportion will be split, come out 380 and 220. So it's pertain to state A, state B. A may recover such UTPR TUT 380 by denying deduction of 1900, that's come out 380 divided by 20% as the tax rate is applicable. So this is the pay. They will apply UTPR. So now we come challenges. Suppose your Mauritius company is earning dividend income. Your Mauritius company have profitable entity and wants to give you dividend, and Mauritius is not liable to tax. Same thing, you do not claim anything deduction under section 80M. So what is happen? It is free float to the shareholder as dividend too, and shareholder is liable to tax 34% because now dividend is taxable under the hand of shareholder also. So in this case, there is challenge of UTPR, in challenge of IRR. So because ATM is claimed by Indian company, so nothing is taxed in the hand of Indian company in respect of Mauritius 1000 profit. So what the rule says, they will apply IRR in respect of Mauritius profit, since we have claimed ATM deduction in respect of this 1000 profit. If they don't claim ATM, in that scenario 35.4% is taxed at this company level, and this will allocate it to the bottom level to Mauritius. So IRR is not applicable in that particular case if ATM is not claimed. So another challenge is in respect of dividend, STB. Suppose your operating company in some high tax jurisdiction and their effective tax rate is nil and want to declare dividend to STP, SPB, and ultimately going to ultimate parent entity. So in this case, dividend weren't given by operating company to dividend to ultimate parent company. So 34% tax is liable to tax by the ultimate parent company in India. So this will impacted by the Globy rule. Pillar 2 is penalize them because of SPV in between them. This 34% can't go to bottom at SPV level. They can't say now this is pertain to this entity. This can't say. So ultimate parent entity first is paid taxes on this dividend, and another time they have to pay income inclusion rule IRR 15%. So what I suggested, we need to think over this SPV need to be eliminated from the chain of structure. So now we discuss STTR. Suppose you are making your foreign overseas payment through the 15 CB you are making, and some payment is making to UAE in respect of market procurement. Since your overseas entity is there, you are making marketing charges, and your that subsidy not liable to tax. So it suggested 9% STTR is applicable in respect of 1000 CCD interest income earned by the Mauritius company. Taxation in India in that respect is under Article 11 to India Mauritius treaty is there. So 3% tax, 1.5% is foreign tax credit. So what the STTR says, 9% will be applicable subject to restriction of FTC 1.5%. So STTR is applicable in this particular case. So what the third example is there. Suppose you are paying interest expenses to your another entity in UAE that is subject to tax under section 194 LC as per the domestic provision. 5% you levy as withholding tax, so balance 4% is STR is applicable. So suppose you are paying some kind of fee for technical services to the Netherlands company, and Netherlands company is liable to tax on the basis of residence. And FTS clause in the Netherlands treaty says it is tax not tax in the source country because it's a make available clause in the Article 12. So nothing liable to tax in the source country. So STTR provision is applicable. 9% is impacted in this scenario also. So now we discuss a broad concept, broad level, eagle-eyed purview. You are owner of Reliance, you are owner of Tata, you headed around the world, never sunset in any time. So what is happen? Your India tax rate is supposed 25% and you adopted globally. You have one subsidiary in Portugal, turnover is below than 10 million euro and profit is also below than 10 million euro. So ETR is nil, no impact of Globy rule since it is a de-minimize exclusion is there in the Globy rule. So another subsidiary in Malaysia, it's a manufacturing presence but earn more than not more than routine profit. As I said, not earn more than routine profit, you are also excluded under the purview of Globy rule. So no IRR is applicable in this case also. So another subsidiary in Netherlands, you are earning interest income 1000 and you are for which you are withholding tax in India at 10%. 100 is your tax in India withhold by Indian holding company. So your effective tax rate for Netherlands entity is 15%. That is suffix the purpose of Globy rule. So no IRR is applicable in this case also. So I take another example of permanent establishment or some kind of subsidiary in Bangladesh. You have invest incentive accredited depreciation as the same case as applicable in case of depreciation under section 35 to AB. You are eligible for 100 200% appreciation. In that case, deferred tax liability need to be computed. So normally profit before tax is charged to current tax and deferred tax. Since accumulated depreciation is there, deferred tax liability need to be computed and some hit in the P&L as taxes. So we will compute effective tax rate including deferred tax. So your effective tax rate is more than 15%, no IRR provision is there. I take another example of Brazil. So in case of Brazil, you have first year profit loss 5,000 and next year 6,000. So first year 5,000 you need to compute deferred tax asset. Same concept IFRS India's is need to be read for the purpose of global rule. So 915% of 5,000 is first year deferred tax asset. Next year your tax post set of tax is 150 plus reversal of deferred tax asset of first year. Total tax is 900. That is your ETR is 15%. 900 divided by 6,000, your ETR is 15%, no IRR is applicable. So this is the purview of global impact. Now I take another example in respect of Marshall Island. In this case, you are running your charter shipping, for which your tonnage tax system is there. So sectoral cap, no global impact. Cayman Island, you are not tax, ETR is nil, so IRR picked up at 15%. So in respect of Mauritius, ETR is 3% due to tax concession on export, notional 80% tax deduction is there, 50% FTC is there. So in that respect, your ETR fall below 15%, difference top-up tax 12% is applicable as IRR. That need to be paid by the ultimate parent entity. So in respect of France, earned income overseas jurisdiction, which tax haven country it's at. In France there is a tax territorial taxation, overseas profit is not tax, and so IRR is triggered. In this scenario is IRR is also triggered. So as I said, dividend capital gain is excluded from the purview of GLOBE. So holding company earning dividend income, capital gain in respect of subsidiary investment. So line by line item consolidated in the CFS statement. So dividend and capital gain is excluded for the purpose of IRR calculation. So hope friends you understand what is pillar 2, what is going on in respect of digital economy, and if you have anything, any confusion in your mind, you can come with me for your any doubt. In this 17th slide, I completely devoted my mind after reading commentary, example, in order to understand in simple words. This OECD BEPS 2.0 commentary is very difficult, as the Netflix policymaker says, if BEPS 2.0 Pillar 2 approach is implemented, then we have to hire army of accountants, because the tax computation will become very big task. They have to comply, first of all understand what is pillar 2 and what impact it, and how it will be taxed around the world, and how to eliminate SPV impact through the challenge of digital tax dividend case, and then comply with this pillar 2. So hope so you understand the concept, and any doubt you can come with us. Thank you.